Welcome to the Deep Dive from Talk Tickers. We break down the earnings call so you don't have to.
Today we're diving into Elite Pharmaceuticals. They just had their Q1 fiscal year 2026 call on August 15th.
Right, a pretty significant one for them, it seems.
Definitely. Our goal here is really just to unpack the key takeaways, give you a clear view of their performance, where they're heading strategically.
And the market's reaction seemed a bit constructive, but maybe cautious.
Yeah, a modest gain, volume was up, sort of a cautiously bullish feel, you know?
Okay, let's dig into why those financial numbers first, because they really jumped out.
They really did. Record revenues, we're talking $40.2 million for Q1.
$40.2 million, how does that compare?
Well, it's up 114% from last year. And get this, that one quarter, almost half of all of last fiscal year's revenue.
Wow, that's some serious acceleration.
It really is. And it wasn't just revenue, gross profit surged too, $27.2 million.
Triple last year.
Triple. And the margin hit 68%. Compare that to 45% a year ago.
68% gross margin in generics, that's unusual.
Highly unusual. Signals something shifting, right? Product mix, efficiency, something.
And operating income.
$21.7 million.
Yeah.
That's more than their entire operating income for the whole of last fiscal year.
Wait, say that again? One quarter beat the entire previous year.
You heard it right. $21.7 million this quarter versus $19.6 million for all of FY25.
Okay, that's impressive. Is the cash flow matching that?
Oh, yeah. Operating cash flow was strong. $14.8 million.
How much of an increase is that?
It's a huge jump. 577% increase from Q1 last year. That's real cash, the lifeblood, you know?
Absolutely. Strong operations, strong cash.
Yeah.
But didn't they report a net loss? How does that square?
Yes. That's the confusing part, isn't it? A GAAP net loss of -1 cent per share.
Right. After all those grid numbers, that needs explaining.
It does. And management spent some time on it. Basically, it boils down to two big non-cash items, accounting stuff.
Non-cash. Okay, that's key. What were they?
First, a big warrant fair value expense, around $22 million.
Okay, warrants from way back when? 2017, I think.
Exactly. It's required by GAAP accounting because their stock price shot up so much, like 67% in the quarter.
Yeah, $1.44 up to 73 cents by June end.
Right. So the value of those warrants went up, and accounting rules say you have to book that as an expense, even though no cash actually went out the door.
So it's like an accounting penalty for the stock doing well.
Pretty much. It looks bad on the bottom line, but it's actually driven by positive stock performance. Management stressed it has zero impact on liquidity.
Wild. Okay, what was the second item?
Income tax expense, $5.3 million.
How does that tie in?
Well, the tax authorities, they don't really care about that warrant fair value stuff for calculating taxes. They tax the real operating income.
Which was really high this quarter.
Exactly. So the tax is based on their strong operational profit, not the weird accounting loss from the warrants.
Got it. So they're paying taxes on actual profits, which is good, fundamentally, even if the GAAP number looks off.
Precisely. And management even made a point about this warrant thing.
Oh.
How's that? They said, if the stock price is lower at the end of next quarter, September 30th, then the next quarterly report, the 10Q, could actually show non-cash revenue from the warrants.
So this accounting thing can swing back the other way, creating paper gains if the stock dips.
That's exactly it. Shows how volatile these non-cash entries can be, totally disconnected from the actual business sometimes.
Okay, that makes a lot more sense. Important to look past that headline loss. What about the balance sheet? Is it holding up with this growth?
Yeah, it's strengthening quite a bit. Working capital jumped significantly.
How much?
Went from $46 million up to $67 million in just 3 months. That's cash for operations, investments.
And debt.
Liabilities. Non-current liabilities are low, $5.6 million, and still decreasing. Management really highlighted this. Low debt, increasing working capital. It's a strong foundation.
Okay, solid financials underneath the accounting noise. Let's talk growth drivers. What's actually fueling this surge?
A big piece is their Elite label portfolio. Remember they launched that back in April 2023.
Right, their own distribution channel.
Yeah, it's not new anymore. It's really established now. Products like their generic Adderall, the Amphetamine IR.
How's that doing?
Holding strong. They've got about 18-20% market share there. That's pretty solid for a generic.
Definitely. But I heard there's a newer product that's really kicked things into high gear.
Absolutely. The star of the show right now seems to be Lisdexamfetamine, or Lisdex.
That's the generic Vyvanse, right?
That's the one. They launched it in a big way, as they put it, back in January 2025.
And it's already making a big impact on revenue.
Huge impact. They've already grabbed about 8% of the Lisdex market.
8% since January. That's fast work.
It is. And the whole ADHD generic market is shifting fast. The conversion from brand name drugs to generics, it's already at 73%.
73%, wow.
And they see it trending towards 90%. That means huge volume potential still ahead as more prescriptions switch over.
That's a massive tailwind. Payers pushing for generics, patients wanting lower costs, elites right there to catch that wave.
Exactly. It positions them really well.
Back to that 68% gross margin. You said it was unusual. Can they keep that up, especially with Lisdex?
Yeah, management was pretty clear on that. The short answer is probably not.
Okay, why not?
That Lisdexamfetamine market, it's super competitive. There are like more than 10 suppliers already in there.
More than 10. Wow. Okay, so price pressure is coming.
Inevitable. As they ramp up volume, and especially as they sell more through the big national wholesalers, those margins are going to come down.
Right. The classic generic life cycle. High margins early, then competition pushes prices lower.
Exactly. It's normalizing. They saw the same thing happen with generic Adderall. You trade some margin per pill for much, much higher overall volume and profit.
So shifting strategy towards being a high volume player.
Seems like it. It's about scaling up.
Good context. So margins likely come down, but volumes should grow. What about other products? Are Adderall and Lisdex the whole story?
Not entirely. They still have decent share in Amphetamine ER, the extended release, about 11%, maybe 14, 15% if you count the old Prasco stock that's still out there, even though that deal ended in March.
Right. Anything else significant?
Their bariatric drug, fendimetrazine, they actually have about 30% of that market. So yeah, they're diversified beyond just ADHD.
30% is dominant. Okay, good. So strong current performance, realistic view on margins. Let's look ahead. Pipeline, strategy, where are they going?
Well, they've kept up a pretty steady stream of launches.
Like what recently?
Generic Percocet, that's oxycodone acetaminophen, launched in April. Before that, generic Norco, hydrocodone acetaminophen, that was December 24.
Okay, pain management, big market.
Right. And clonidine 8-AP last October. Plus, generic methotrexate just launched this month, August.
So consistent additions. What's coming up next?
They're expecting to launch naltrexone and phentermine under the Elite label, likely next month, September.
Okay. And longer-term pipeline. Any interesting ANDAs?
Yeah, two key ones they mentioned. One is generic Xtandi enzalutamide. That's a paragraph 5 filing.
Paragraph 4. So challenging patents, high stakes, potentially high reward.
Exactly. Usually means it's a valuable drug, but there'll be lawsuits.
Right.
The other is a generic dopamine agonist for Parkinson's. So moving into neuroscience too.
Interesting diversification. And I saw something about India R&D.
Yeah, that's looking further out. They expect the first product from their India R&D effort to hit clinical trials in the first half of 2026.
Potential for lower R&D costs, maybe? Any delays? I thought methadone was coming.
Good catch. Yeah, methadone launch is delayed. Seems like manufacturing and packaging capacity is tight, and they're prioritizing other, possibly more profitable products right now.
Resource allocation.
Yeah.
Makes sense. How about regulators? Any FDA news?
They had a recent FDA inspection, came back with what they call minor observations.
Minor. That sounds okay.
Yeah, seems manageable. They're correcting them, responding to the FDA. Said they're confident in the facility. No big red flags reported.
Good. And are they looking beyond the U.S. now?
They are. Just made their first shipment of amphetamine IR to a partner in Israel, Dexel.
Israel. First international shipment.
Yep. Second order is apparently pending for later this year. So, testing the waters internationally, opening new doors.
Okay. Now, the big picture strategy, they talked about evolving, right? Moving beyond just being an ANDA player.
Exactly. They want to become a broader, self-distributed generics platform. And the main way they plan to accelerate that, M&A, mergers and acquisitions.
M&A is the focus. Did they give any timeline?
They did. And this was really interesting. Management basically put their M&A team on the clock.
Oh, how so?
They said the team has until the end of this calendar year, 2025, to show serious progress or achieve a desired outcome on M&A deals.
Wow, a public deadline. That's unusual. What happens if they don't hit that M&A target by year end?
They have a plan B. If M&A doesn't pan out by then, they'll pivot and seriously consider a NASDAQ uplisting in the first quarter of calendar 2026.
NASDAQ uplisting.
Oh.
So moving from the OTC market to a major exchange.
Right. To boost liquidity, visibility, attract more institutional investors. They see it as the alternative path to maximize shareholder value if the M&A route doesn't deliver quickly enough.
That's a very clear dual-track strategy with a hard deadline. Impressive clarity.
One last thing, macro stuff. Drug pricing? Tariffs? Did they touch on that?
They did. On potential efforts to lower drug costs, like from the Trump administration, they don't see a big impact on generics.
Why not?
Their view is generics are the solution. They're already the cheap drugs. The focus is usually on branded drug prices.
Makes sense. Tariffs on ingredients.
APIs, the active ingredients, have been exempt, fortunately. For other things, like maybe bottles or components, if costs go up, they expect the industry will adjust prices to cover it. Seems they feel the generic market is resilient there.
Okay, let's wrap this up. Pull the key threads together.
Right. So Elite showed really strong growth, impressive cash flow, driven by their Elite label, especially generic Adderall, and now this big Lisdex launch. But we need to watch those Lisdex margins. Expect them to normalize lower due to competition. That's just the generics game.
Exactly. Meanwhile, the balance sheet is getting stronger. Low debt, good working capital. And critically, they have this clear strategic path forward.
Focus on M&A until year-end.
With a NASDAQ U uplisting as the backup plan for early next year if needed. Clear catalysts are on the horizon, one way or another.
So, strong operations, navigating some accounting complexity, facing market realities, but with a very defined plan for value creation.
That sums it up well. That's why the market seems, cautiously optimistic. They see the growth, understand the margin pressure, but also see these potential big moves coming soon.
All right, now for our disclaimer-heavy, purely illustrative, this is not financial advice segment.
Emphasis on not financial advice. This is just thinking out loud about potential scenarios. Highly speculative. Do your own research.
Okay. So given Elite's very explicit deadline M&A progress by end of 2025, or a pivot to NASDAQ Q uplisting in Q1 2026, here's an outrageous but plausible idea. Again, just an idea.
Listener, beware.
You could theoretically look into long-dated, slightly out-of-the-money call options on Elite, maybe expiring early Q1 2026.
Why that timing and structure?
Because management themselves set up potential catalysts right around that time frame. A major M&A deal announced before year-end. That could move the stock. No M&A, but a confirmed plan to uplist to NASDAQ Q in Q1. That could also move the stock.
So you're betting on one of those two specific events happening, as outlined by the company, serving as a catalyst within that options timeframe.
Exactly. It's a bet on a binary outcome tied directly to their stated capital strategy and timeline. Highly speculative, leverages the potential impact of those specific corporate actions.
And the risks are huge, obviously. M&A might fall through, and they might delay or cancel the uplisting plan. The options might not even be readily available or liquid on the OTC market. The stock might not react as expected, even if an event occurs.
All true. Huge risks. This is purely about illustrating how stated corporate timelines could inform a highly speculative trade structure. Again, not advice.
Understood. It highlights how strategic clarity can sometimes create defined event paths to watch.
So what stands out to you listening to this? What do you make of Elite's quarter and their path forward? Feel free to continue your own deep dive.
Thanks for joining us on the Deep Dive from Talk Tickers.